Debits and credits, simplified to mastery. In this video, debits and credits will be explained, their use of double accounting, and finally how they interact with the balance sheet and the profit and loss statement. Let's get started. Debit means left side. Credit means right side. That's it. Here is a T account you may have seen before. This is a nice way to visualize that, again, a debit is on the left and a credit is on the right. The sole purpose of debits, credits, and the T account is to make sure everything is balanced. The debits on the left side equal the credits on the right side. This is the double accounting principle. Now let's see how these interact with the balance sheet and the profit and loss statement. The balance sheet is so named and can be thought of as not only balancing, but each item on the balance sheet has a balance based on the date and or time of reporting. For example, think of the daily balance of your checking account. Now let's introduce the three main parts of the balance sheet: assets, liabilities, and owner equity. In equation form, assets are equal to the sum of liabilities plus owner equity. A balance sheet report is listed top down, totaling assets on the top that are then equal to the sum of liabilities and owner equity. For this video, it is easier to look at it in linear equation form. Now let's abbreviate the equation and see how debits and credits are utilized. We'll spread out the equation to make some room, bring in a T account for assets, and another T account for the liabilities and owner equity side of the balance sheet. Just like before, debits and credits equal each other, and now debits and credits on the left side of the balance sheet equal debits and credits on the right side of the balance sheet. As a side note, the total sum of all debits and all credits can be found in the trial balance or general ledger. If your brain works on pluses and minuses or additions and subtractions, then what's next should help. Debits on the left side within assets are pluses or additions. Credits on the left side under assets are minuses or subtractions. Now get ready for possible brain freeze because the opposite is true on the other side, the right side of the balance sheet or liabilities plus owner equity. On the right side, credits are pluses or additions, and debits are minuses or subtractions. Now you know exactly why debits equal left side of each T account and credits equal the right side of each T account, because pluses and minuses mean different things to each side. Next, we'll see why. One of your favorite assets is more than likely your checking account, your cash. Let's say you personally put $100 into your company checking account. This represents a debit, an increase in cash. Now let's see what happens to the other side. The offset account could be a credit to owner equity and represents an increase to all debits and credits are equal and the balance sheet is balanced. Now let's see what happens when you take some money home. As you could imagine, your checking balance goes down, in this example by a credit of $50. Since you know that debits and credits need to balance, then, in this example, it is a debit against owner equity, reducing owner equity by $50. Now let's simplify the profit and loss statement. The top of the P&L statement is sales, or money in. Then money out in the form of cost of goods sold, or COGS for short, and then expenses. And finally, what's left over, known as the statement name itself, your profit and loss. Here is a quick overview of what is happening when money comes in. If you guessed that checking is debited, you are correct, representing an increase as cash comes into your company. So what happens on the other side? Sales are credited on the P&L, an increase in sales. Here is what happens when money goes out. As you spend, you would expect a credit to checking against your cash, and this is a reduction or negative amount. On the other side is a debit to, say, an expense account. In effect, it is a subtraction against the sales that are coming in. Okay, Last trick, and get ready for possible brain freeze once more. For this tutorial, this is the last interaction between the balance sheet and the profit and loss statement. Ready? If your company ends the period, usually a year, with a profit, that ends up being a positive, literally, and is a credit on your P&L. So logically, a debit goes into retained earnings, which is also a positive, an increase. If your company unfortunately had a loss for the period, then the opposite is true, a debit on the P&L and a credit on the balance sheet. Both are reductions. This concludes this tutorial. Hopefully, debits and credits have been simplified. You have a greater understanding of double accounting, the balance sheet, and the profit and loss statement. Thank you for watching. Please visit my website for more upcoming tutorials at bbllc.us. Cheers.